got to tell you, this whole rate cut thing, I think people have had enough talking about it, but it's just starting if you really think about it. And, you look at what the Fed looks at, and, they're kind of supposed to look through a crystal ball, but looking at the information they got, it's more like a bowling ball.
Yeah, I would say so. And in terms of the data that they were really relying on to justify being on pause since December of 2024, right? So they went basically 9 months on pause because they thought that the labor market was really solid, and then they were fearful that tariffs would have an immediate inflationary effect. Well, comes to find out, the labor market wasn't quite as solid as what they had thought, and inflation isn't really raging in a boil that like they had feared. So I think that in terms of the data, you've talked about this a lot of times about the looking backwards versus looking forwards, and it kind of feels like they pivoted from looking backwards, being more reactionary to the data as it rolled in, to trying to base things off of fear about what would happen in the future, and then they ended up being wrong. Yeah,
and that's the reason why looking backwards, looking at facts and circumstances, it's easier to look forward, but we saw some evidence this week that gave us two pieces of information. Number one, the labor market was slowing down last year as expected, and then one thing that you continue to say about the two mandates, and I at least I say about the two mandates, and then you corrected about three mandates, that came out this week.
It did. It was really interesting because Stephen Myron, who was just appointed as a board of governors to the Federal Reserve, during his confirmation hearing, he reminded them that in the statute that empowers the Fed to do what they do, it gives them three goals, not two. So it's full employment.
Isn't that funny? Because how the dual mandate, how long have you heard that our entire career, right?
Oh, yeah.
But now there's three jobs, and you have said that. I have to give you credit for that.
Well, thank you. I do appreciate that. But in terms of back in 2010, former Chairman Bernanke, he was asked about it once, and he said, well, if we get the full employment and stable prices done, automatically the third mandate, which is moderate long-term interest rates, that just follows. But not always. Sometimes these three mandates can be in conflict. We saw that during the global financial crisis, during COVID, when the Fed intervened with like quantitative easing, the asset purchases. In a way, the way that they could justify that, I think, was financial stability, but also with that third mandate. And Myron pointed out that, that is part of our job. So it should be part of the conversation.
And so now you look at these two things and why this is important to everybody, right, is that they have lowered interest rates. And, this is kind of a social commentary as well, right, because it's a bifurcated economy that we live in, right? There are people who are truly affected by inflation. And there are some who are saying lower interest rates are going to make my portfolio go up, right? So, it's not everybody's on the same page right now. But more importantly, as we look at it through the economic eyes, is lower interest rates mean that you're going to get a rally perhaps in not only fixed income, but equities as well. We saw that in small caps.
Oh, yes.
After 1,000 days nearly, right? We finally are back to where we were.
That's right. I think, was it like November 2021 or something like that, is when the small caps, Russell 2000, they were previously at their peak, and they had been really trying to climb out of that hole ever since. In this past week, they finally got to that point. Well, everybody else is focused on like the S&P 500, so the 500 biggest companies, or the NASDAQ, this more technology-focused index. Those are the companies that they don't have a lot of debt, whereas smaller companies tend to have more debt. And so they're much more sensitive to changes in interest rates, the cost of funding. And I like how you brought up about this bifurcated economy as well. If you think about the people who could benefit the most from lower rates, think about a credit card bill. The average interest rate is 22.25%, right? So if you can lower that cost of borrowing, those are the people who are also most affected by inflation.
Right.
So they could get a double benefit in terms of if we get a little bit of relief on the rate side and if inflation continues to trend lower.
And you think about it, about 60% of Americans are invested in equities markets, either through their 401k, but there is a percentage of people who will go to the bank and look up on the board and say, what is the CD paying, right? And forever, a long time, it started with a decimal point, right? It was under 1%. And now 4 to 5% CD rates are normal. So as interest rates start coming back down, those savings rates are going to come down as well. And so all of this, folks, puts together what it should look like in your financial plan. And everyone's different. I guess that's the point I'm trying to make, Brian, is everyone is different on their risk parameters, on their age, how much they've saved. And that's the reason why we walk through all of these different choices to say, what is in your best interest? And are you working with a fee-only fiduciary? That's when we walk through this process.